Warren William here, Smartest Data, quick definitions. Valuations. What is meant by placing a valuation on a stock? What are the common valuation techniques? Let's go to the video, define and explain valuations, and at the end of the video there'll be 3 quick bullet points to take away. A valuation is done to determine a theoretical price for the shares based on forward projections. There are 2 broad valuation methodologies: ratio analysis and an intrinsic valuation. The overall objective of determining a stock's valuation is to estimate a theoretical price value, commonly known as a price target. The valuation has nothing to do with the current trader's share price, the relevance being is it above or below the current price and by how much. To determine a price target for a stock requires researching an analysis and an estimation of a company's future earnings. Therefore, a forward projection requires an understanding of the key dynamics in the 3 financial statements: the growth potential of the P&L, then how the company is financed, key being leverage and liquidity, and is the cash position positive. Starting at the top line in the P&L, sales, thus product pricing times volume, so demand and competition, then operating expenses, then interest expenses and taxes, leading to net earnings. The valuation of a stock and ultimately determining a target price can be done by either a relative valuation or an intrinsic valuation. The relative valuation is done via the key valuation ratios: price divided by sales per share, PE ratio, dividend yield, and price divided by cash flow per share. The multiples and yields of the current ratios are then compared to the historic mean for that ratio, as valuation multiples tend to be mean reversing unless justified. For example, due to continued growth via product innovation, Apple enjoyed a multiple expansion over the past 2 decades. Then the multiples are compared on a relative basis to the forward mean sector valuations and the mean index valuations projected for the next 2 years, also taking into consideration potential growth rates. A higher PE ratio could be justified if the potential growth rate is higher. The other method is via an intrinsic valuation, such as the discounted cash flow. The objective is to determine the net present value of the stock's future cash flow and terminal value at an appropriate discount rate. The appropriate discount rate can vary between investors. It is the return required for the extra risk in investing in the stock, being the risk-free rate plus the market risk premium. The NPV is then divided by the number of shares to arrive at a valuation per share. A comparison to the current share price, and if the NPV is higher, this is positive; lower, negative. Valuation and possible scenarios must be constantly monitored to assess the impact of any changes, up or down, to future earnings and economic data. Three takeaway bullet points regarding valuations. It is done to determine a theoretical share price for the shares. It involves researching analysis to estimate a company's future earnings. 2 main valuation methodologies: ratio analysis and an intrinsic valuation.